New York, October 1907. Outside the banks, depositors pressed against locked doors, demanding cash before the cash disappeared. Inside the stock exchange, the cost of overnight money surged toward 100%. Trust companies were failing, credit was freezing, and the world's fastest-growing industrial economy was running out of confidence. The United States had no Federal Reserve. No public institution could create emergency liquidity and command the financial system to stand together. So the most powerful bankers in America gathered in a private library on Madison Avenue. At the center of the room sat a 70-year-old financier with no elected office and no legal authority over the nation. Yet money moved when he gave the signal. His name was John Pierpont Morgan. By the end of the crisis, he would be praised as the man who stopped a panic and feared as proof that one private citizen had become too powerful. Morgan did not build his empire by inventing a product, discovering oil, or owning a single industrial monopoly. He built it by controlling the gateways through which other empires received money. He connected European capital to American expansion. He rescued companies, rewrote their debts, chose their directors, and sold their future to investors. Railroads, electricity, steel, government bonds, and finally, the stability of the banking system itself passed through his network. This is not simply the biography of a rich banker. It is the story of how financial credibility became a form of political power. John Pierpont Morgan was born in Hartford, Connecticut, in 1837. His father, Junius Spencer Morgan, was already becoming an important international banker. Pierpont's education moved between Boston and Europe, ending with study at the University of Göttingen. He learned languages and mathematics, but the most important lesson came from the world around him. America possessed land, factories, rail routes, and ambition. Europe possessed much of the capital required to develop them. Whoever could earn the trust of London while understanding the opportunities of New York could stand between two continents and charge for the connection. Morgan's career began at exactly that junction. In 1857, Morgan entered Duncan, Sherman and Company in New York, the American representative of George Peabody's London banking house. He learned how securities were placed, how reputations were assessed, and how distant investors decided whether an American promise was worth buying. By the 1860s, he was acting as his father's New York agent. His advantage was not only access to money, it was the ability to certify risk. An investor in London could not personally inspect every railroad, mine, or factory in the United States. He needed a name that could stand between information and uncertainty. Morgan worked to make his name that guarantee. In 1871, Morgan and Philadelphia banker Anthony Drexel created Drexel, Morgan and Company. The firm became an issuing house for governments and corporations seeking large pools of capital. Its real product was not a bond certificate. Its product was belief. Morgan examined a business, organized the financing, assembled a syndicate, and placed the securities with investors. If the deal survived, his reputation became more valuable. If his reputation became more valuable, the next deal became easier to finance. This created a self-reinforcing machine. Trust attracted capital, capital created influence, and influence produced more opportunities to manufacture trust. The railroads gave Morgan the stage on which that machine became visible. By the late 19th century, competing lines had borrowed heavily to build overlapping routes. They cut prices to steal traffic, weakened one another, and repeatedly collapsed into receivership. To investors, railroad bonds that once promised national growth now carried the smell of failure. Morgan entered not as a locomotive owner, but as a financial surgeon. He refinanced debt, negotiated with creditors, reduced destructive competition, and installed directors who would enforce the new structure. The process became known as Morganization. A failing railroad emerged with cleaner finances and renewed access to capital. but it also emerged tied to Morgan's banking network. Control did not always require owning every share. It could be exercised through debt covenants, voting trusts, board seats, underwriting relationships, and the knowledge that future financing depended on continued cooperation. Morgan was turning the architecture of finance into the architecture of command. This was the central mechanism of Morgan's power. First, identify a system that was large, essential, and financially unstable. Second, gather creditors and investors into a single restructuring plan. Third, replace fragmented management with a hierarchy that could be monitored. Fourth, place trusted representatives inside the company. Finally, use the Morgan name to sell the reorganized company's securities back to the market. The company received survival. Investors received a promise of discipline. Morgan received influence that could endure long after the original rescue. Morgan believed that uncontrolled competition could destroy value faster than innovation created it. His answer was consolidation. In the electrical industry, he helped combine Edison General Electric with Thomson Houston to form General Electric. The merger joined patents, factories, engineers, customers, and financing inside a single corporate structure. To admirers, this was rational organization on a national scale. To critics, it was the replacement of open competition with private financial government. Both descriptions contained part of the truth. Morgan's largest industrial creation began with steel. Andrew Carnegie had built the dominant production system. Charles Schwab argued that the industry could be assembled into something larger than any individual steel company. Morgan supplied the financial machinery. In 1901, Carnegie Steel, Federal Steel, and other properties were combined into United States Steel. It became the world's first billion-dollar corporation. The scale was difficult to comprehend. A private financing operation had created an enterprise whose reach extended from mines and rail transport to furnaces, mills, and finished steel. Morgan had not merely funded a company, he had designed an industrial state within the state. By then, Morgan's influence had moved beyond corporations. In 1895, the United States Treasury's gold reserve was being depleted during a severe monetary crisis. Confidence in the government's ability to maintain gold payments was weakening. Morgan organized a private syndicate that supplied the Treasury with gold and helped restore confidence. The rescue was controversial because it appeared to place public monetary stability in the hands of private financiers, but it also revealed an uncomfortable reality. The federal government possessed legal sovereignty. Morgan's network possessed immediate access to capital, information, and coordinated action. In a crisis, speed could matter more than formal authority. 12 years later, the weakness returned in a more dangerous form. In October 1907, a failed attempt to corner United Copper stock damaged banks connected to the speculators. Rumor crossed institutional boundaries faster than investigators could establish the facts. Depositors began running on trust companies, lightly reserved institutions that supplied important short-term credit to Wall Street. Knickerbocker Trust came under pressure. Morgan asked Benjamin Strong to examine its condition, but the books could not be assessed with confidence in the time available. Morgan declined to support it. After almost $8 million was withdrawn, Knickerbocker suspended operations. The suspension transformed anxiety into systemic panic. Runs spread, stock market credit disappeared, and overnight rates exploded. This was no longer the failure of one institution. It was a crisis of the connections holding the financial system together. Morgan now became the central coordinator of a rescue that involved bankers, trust company executives, industrialists, the clearinghouse, and the Treasury. He gathered information from across the system and forced institutions to reveal which assets and obligations were real. He solicited cash from major financial and industrial organizations. Funds were delivered directly to the loan post at the New York Stock Exchange, so brokers could continue extending credit. Morgan and his partners decided where support could preserve the system and where a rescue would merely postpone failure. The decisions were made under pressure, behind closed doors, by men whose private interests did not always match the public interest. Yet the machinery worked well enough to prevent the panic from becoming an immediate national collapse. Morgan did not act alone, but no public official occupied the coordinating position that he did. For those weeks, his library functioned like an improvised command center for American finance. The rescue increased Morgan's prestige and deepened the fear surrounding him. If a private banker could decide which institutions received liquidity, he could influence which institutions survived. If his partners sat on corporate boards, underwrote securities, held deposits, and controlled voting trusts, finance could become a web of reinforcing power. Congress investigated that web through the Pujo Committee. Its report described interlocking relationships among major banks, trust companies, insurers, railroads, utilities, and industrial corporations. During testimony, Morgan was asked whether commercial credit rested primarily on money or property. He answered that the first thing was character. Before money, before property came trust. It was the purest statement of the Morgan system. It was also the reason the system could never be fully separated from the judgment of the man at its center. The Panic of 1907 accelerated a national movement for monetary reform. Congress created the National Monetary Commission, debated competing plans, and eventually passed the Federal Reserve Act in 1913. Morgan died in March of that year, months before the act became law. The new system was not created simply to replace one banker. It was created because repeated crises had shown that a modern economy required an organized source of emergency liquidity and public authority. What Morgan had improvised through reputation and personal networks would now be attempted through law, reserve banks, and a national system. J.P. Morgan was not merely a rich man standing beside American capitalism. He helped design the institutions through which that capitalism operated. He made unstable companies financeable, large combinations governable, and American securities credible to global investors. He also demonstrated how easily financial coordination could become concentrated authority. His career leaves a question that belongs as much to the present as to the Gilded Age. When markets depend on a small number of institutions for credit, information, and rescue, where does economic power actually reside? In the government that writes the rules? In the companies that produce the goods? Or in the financial networks that decide who receives the money to continue? Morgan's answer was written not in theory, but in railroads, steel mills, treasury gold, and a library full of frightened bankers. For one generation, American finance did not merely know his name, it moved through it.